Hello, today is March 22nd, and we want to cover an article that we wrote over the weekend called Groundhog Day. And we call it Groundhog Day because we wrote an article back in January, which you can see on our website, and it's called YOLO No, which outlined the risk in the market at the time. And those were low levels of options-based hedging, meaning no puts, low levels of stock shorting, a ton of call options, and a lot of margin utilization. So following that, there was a really violent correction in markets. And it was about a 4% correction that happened about twice, which was very quickly bought back. But what it did produce was two of the largest VIX spikes in history over such a short time frame, meaning that the volatility in markets was extremely high. And this is a function of leverage. When you get a more leveraged market, the down moves now, instead of being a minor correction, turn into major violent shifts down, and also the rebounds are very quick and explosive. And what's concerning to us about that is that if you consider the 4% record VIX spike, 4% drop in markets in the record VIX spike, what would happen if there was actually some fear or panic in the markets? It could be just really an unbelievable correction, and that is kind of what our concern is that not that the market is going to go down structurally or that something's really wrong. We should be clear that we think the market goes up over time, right? But there are periods of excess where those need to consolidate and adjust, and we need to rebase, and then markets can go higher. What's happening now is that people are stretching the rubber band to the upside, and we're going to talk about why we think that is. So first, we're going to talk about realized volatility. Realized volatility tells us how much the market has moved. If you look at here, we have 5-day realized, 1 month, 2 month, 6 month, and you can see that after the COVID crash, which is here, realized volatility has remained very high, and you can argue that it's starting to expand now. And so when you have higher realized volatility, the volatility that's happened, that implies that future volatility is going to be higher. And that can make the price of options increase and suggest that we could have even more volatility going forward. Now, that being said, the VIX, of course, broke down a little bit today. We're down to 19. And so it is quite possible that volatility now contracts, realized volatility contracts, and that the market just keeps on doing what it's doing. But that's just going to stretch this rubber band higher. If you recall, the August of 2020 period, we had something like a 10% move in a month, and that corrected in about 2 or 3 days, right? And the markets just really crashed very quickly, but then paused, consolidated, and continued its upward trend. And that's something at a minimum we think we'll see near term. Add or attribute to this issue of realized volatility is that liquidity has decreased. So this is a Goldman Sachs chart of liquidity in the E-minis, which is the primary futures used for hedging the SPX options as well as SPY. And you can see here that they are telling us that top of book liquidity has decreased. So what does that mean? Well, it means if you are a big institution and you need to say buy or sell 100 or 200 futures, in the past, if you needed to buy, let's say, futures at 39.50, you needed to buy 100 futures, you could get filled at, say, 39.52. But now maybe you have to get filled at 39.55, right? Because there's less liquidity available, you have to pay a higher price to trade. So that means if there is ever a drawdown and people panic and really need to hedge, which typically happens on the downside, this lack of liquidity means that traders are going to have to sell through larger price ranges to get their fill. This invites more volatility to the market, so it's a major concern. On top of that, I'm going to skip this chart. On top of that, the put options that are currently in the market are almost non-existent for the SPX. Now, the SPX is where we think the biggest institutions in the world hedge. Bridgewater, Point72, those really big funds, insurance funds, they're going to buy puts in the SPX using the SPX to hedge. That is because the notional value of the SPX is so large, and it's a broad market measure. You can see in this chart that the VIX spiked obviously in the COVID crash, and it has not mean reverted to levels seen before the crash. However, the blue line here, which is the SPX put volume on a 30-day rolling basis, is well below 2020 levels. So that's telling us that just the daily volume or what people are looking for hedges is just not there. In a related measure, here we look at total call open interest in single stocks versus put open interest, and you can see that on an ever increasing margin, people are buying and holding call options as opposed to put options. Now, this continues as the market keeps going higher and higher and higher. Now, we keep getting more stimulus, and the economy looks like it's going to reopen, etc. And so here we can see that the investors are increasingly looking to get longer and longer calls. This is also shown in our OCC data, which is showing that equity call buyers, now these are buy to open, and this is in premium, uh, total premium, you can see that people are spending way more on calls than they ever have before versus puts. Now, this chasm existed before the COVID crash back in here, but it's just grown wider and wider and wider as the year has gone on. Now, the names that people are trading in are quite speculative. Many of these companies maybe they have great futures, right? But right now, look at Palantir, AMC, GME. Those are not necessarily the type of companies you would expect that the record, top 20 options volume names to be in. They're small cap names. They generally don't have much investor interest, but the fact that these names highlighted in blue are all top names in the options trading volume ranks tells you that there's a lot of speculative interest in markets. Along with that, we see again from Goldman that short interest in the S&P is at record lows, not seen since the year 2000. So we have very low short interest, which means that if there is a reason for markets to sell or to sell short, the issue is that when you have low short interest, there's no bounce fuel, right? Because typically what happens is investors are short a lot of stock as the market goes down. They buy to cover, right? They close their position, and that helps to hold the market up. But in this case, and this goes for puts as well, if we all suddenly decide that we need to hedge by shorting stock and by buying puts, both of those put a lot of pressure on the market and means that they're not going to cover for, they won't cover their position for a much lower level. So what does that mean? Well, here you can see the outperformance of the tech sector versus IWM and SPDRs. So IWM you could consider sort of a value metric, and SPDRs is just the broad-based measure of market. So we have tech, which is just ripping higher, IWMs, which has started to increase. There can be some rotation there, but there's a big chasm here, and the QQQ has been the recipient of a lot of the tech flows, right? A lot of tech speculation. And now some are saying with higher interest rates and the like that this would need to correct, right? That we could see this rotation push down so that the performance of these two numbers, of these three markets consolidates or contracts, back to something like we've seen, more towards 2019 or 2020. Now the issue with that, as we scroll a bit lower, is that most of the components in the S&P, the top components, are tech related. So if there is heavy selling in the S&P, then we may see heavy selling if there's heavy selling in the Qs, then we may see heavy selling in the SPDRs, just as a function of the fact that so much of the S&P is technology weighted. So with that, we're going to close. We hope this was helpful. If you want to read a little bit more in depth, please do. Again, if you go to spotgamma.com and click on the blog, you can read this full article. We also post about this on our Twitter @SpotGamma. If you have any questions, please send us an email at info@spotgamma.com. Thanks.